Welcome back to another segment of Arizona Mortgage News Insider Update. We're here with our resident expert, Mike Goblet of United Mortgage and Financial Group. Good morning, Mike.
Good morning, Matt. How are you this morning?
Not too bad. Surviving the heat.
Well, there's a lot of that going on this past week, hasn't there been? So,
Absolutely. We can't all understand the weather here, but it sounds like you can help us understand a little more about the process of underwriting.
well, this is part of the series that we talked about things to understand during the mortgage process. And one of the key things, if you've ever done a mortgage or heard about them, you hear about underwriting and underwriters, almost being a scary terminology in the process.
Yes, absolutely. They're usually penned as the bad guys.
They're often perceived that way. So I think it's important to understand their role and actually what are they looking for. So essentially, an underwriter's role covers two areas: verification of the applicant and verification of the property. Okay? Now, the underwriters usually fall into what they call the 4 C's of underwriting. And that's the terms, the C's are capacity, credit, cash, and collateral. That's a simple understanding. Now, 3 of those reflect the applicant, verification of the applicant. So let's look at each of them. What does capacity mean? Okay. And what capacity is, and what the underwriter looks at, is the ability of the applicant to repay the mortgage. And that's really the term that's used today, the ability to repay. So the underwriter goes in, they check first to make sure that the information on the application is correct, essentially correct. Number 2, that the debt to income ratios of what was said and versus what we can prove with income and salary, etc., does meet the ability to meet the ratios that are allowed. Does that make sense?
Makes sense.
The credit, from that point, once they've verified the income and etc., they will review the credit report, okay? And they really look at that in terms of this determines, as we've talked about in the past, the risk level of the client. Now, that first and foremost begins with your credit scores. The higher your credit scores, the less risk you are considered. The lower your credit scores, the greater risk you pose. But there are other things on the credit report besides just your credit scores that we get. They need to look at, is there anything in your history of late payments, etc., that jump out that say this person could be a risk. Number 2, they look at, are there any bankruptcies or anything showing on your credit report, even though you might have a good score today, but that could influence or impact your ability to qualify for this mortgage. So they go through the capacity in terms of the ability to repay, the credit report to view the risk level, and then the 3rd C is cash, okay? To make sure that the income or the cash that you're saying for the transaction is available. For instance, if it's a purchase, that the money is there or will be there, okay? That becomes important because you can't just come up with cash for a transaction and all of a sudden say, hey, I had it under the mattress and here it is. Money has to be seasoned for 90 days to be part of the transaction or come from sources that are consistent, like a paycheck's now coming up and that will, help provide the cash, or the sale of a current home so that you have the down payment. So these are the things that the underwriter looks at when it comes to the cash portion of the transaction.
Gotcha.
The 4th C gets into collateral. And what that means is the property itself, the collateral for the loan. This is where the underwriter is actually responsible to review the title. Now, they don't go get the title, but they have a title company do that. but they then review it for the accuracy, make sure there are no liens on it, or what are often called clouds on title that could impact the loan to the lender down the way. So they do that. They also then review the appraisal when it comes in, and to make sure that the appraiser did the appraisal correctly, that if there were any notes made by the appraiser, how that could impact it. For instance, an appraiser might say, there's a problem with this. And so the underwriter has to go in and say, this has to be fixed before we can approve it, if that makes sense.
Certainly does.
Okay. So they go through the appraisal. And then finally, there are other situations about the collateral that they have to verify that involve the insurance. Pretty simple. The homeowner's insurance, make sure it's up to date, and that there's a year's coverage paid in advance. And then actually a fourth thing that many people don't consider is a flood certification. And we often hear from clients saying, I don't need a flood certification or the fee attached to it. I'm not in a floodplain. Well, it's the underwriter's job or task to prove that, not just accept it or think that's the case. They need to prove it. And I can tell you, part of every transaction, there will be a flood certification that's necessary to prove it's not in a floodplain, or if it is, that flood insurance is needed. Now, it's not a junk fee. Whether it's shown or covered with the rebates that we talked about in the past, the flood certification is a necessary part of proving the collateral meets all the responsibilities for it. And the underwriter does all this in the viewpoint of, can we sell the loan to the secondary market, Fannie or Freddie, or the private investors that they use, and just make sure that the loan is cleared and prepared for that step. This is the person that actually does say, yep, everything's in order and we approve the loan, or no, we don't approve it, and for these reasons.
Well, got to pay attention to the 4 C's, it sounds like. And that flood insurance always throws people in Arizona.
Actually, the funny part about that in Arizona, and I get a kick out of this, that actually if you look at the 100-year flood plan, almost all of Phoenix is in the 100-year flood plan. And, if we got the rains that are going on in Texas right now, you know what? People who didn't think they were in a floodplain probably end up in one.
For sure. Well, good stuff to know. And you don't really have any influence over the underwriters other than getting your 4 C's in a row before you send it that way.
Actually, that's a very important part, because part of what we do, and Jean, my daughter and processor, is really good at working with underwriters and has worked with them for the years. She knows how to prepare the file for what they will be looking for, ask for things in advance so that we can make the process go smoother for the underwriter, because Jean works with them on a daily basis and pretty well understands what they're going to be looking for.
Well, that's a great experience to have. It doesn't come with all mortgage crew, does it?
No, it does not. We take everybody's loan very personally and try to make sure that it will get approved when we think it will at the very beginning, and help the underwriter understand this is why it makes sense.
Excellent. Well, this was, as always, great information. If people do have questions about the underwriting or mortgages in general, what's the best way to reach out to you, Mike?
Well, you can call the office here at 480-503-3533. You can call my cell phone directly at 480-220-2329, or email me at mike.goblet at our company initials umfginc.com.
Excellent. Well, stay cool, Mike. Thanks again for another good segment.
You too, Matt. Have a great day. Look forward to the next one.
Sounds good.
Okay. Have a good day.
Bye-bye.